Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about inflation, new home sales, existing home sales, and prepayment penalties on mortgages to lower mortgage rates. As always, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
Sarah, I don't know how to say this, but I think I got my hair to be bigger than ever.
No, I was going to say that. It's like 2 inches tall.
I had a different person cut my hair, and then this is like the Great Wall of China now, man. It is just, it's up there.
Listen, this is first world problems. Everyone would like to have that problem, but it is really tall.
It is. So we'll see how long this lasts, but it should be interesting on stage.
Okay, well, let's talk. We have so many things going on. Want to start with inflation or mortgage spreads?
Last Friday, when I talk about mortgage spreads were very, very wild. It was abnormal trading on Friday. It was kind of a precursor to what we're seeing this week. And today we had the inflation report. It was tamer than estimates. And then the 10-year yield fell a few basis points. It's just back and forth, nothing really big. But pricing went up about six basis points, nothing too dramatic, but it went up. The mortgage spreads are very, very volatile. Over the next few trading days, things should calm down a little bit. But if you're confused, I understand. But what happened Friday, that was abnormal. That was like double what a really unbelievable day would be like. And they're just working itself out. So mortgage rates are just a tad higher on a day that I think a lot of people thought they would be lower. And that's my explanation for that. And that's why I talk about we get some volatility on spreads and pricing until it calms itself down and we push forward with it.
Also, we don't really know, like on that MBS buying, we don't know what the timing of that's going to be. And that would affect things, right?
Well, I mean, traders kind of trade in herds. So, you had a lot of people get ahead of that news. I mean, they were already buying 70 to 80 billion. They, Freddie and Fannie used to be big buyers of the MBS market. But in context, remember, we started the year at 2%. We're not that far from normal, even if
on spreads.
On spreads, we are. Even if there was no MBS purchases, we would have gotten basically toward back to that 180 level, but at some point this year. But to me, that was just a very violent move, and it's confusing some people. So I just wanted to address that first.
So you feel like we're about where we are now is what you could expect for the rest of the week?
Well, it takes a few trading days. It's confusing to people see the 10-year yield down and mortgage pricing go up. And then yesterday when 10-year yield rose up a little bit, mortgage pricing got down. It's the spreads gone wild, right? We're going to do like an old DVD thing like that. And, mortgage spreads gone wild pricing, that's just how these things happen when you have a Titanic announcement and traders weren't ready, you get some dislocation in the pricing.
Okay, let's talk about inflation.
So CPI inflation came out. PPI inflation will be out, I think, this morning as well. The growth rate of inflation is slowing on a year-over-year basis. Nothing too dramatic, but the breakaway inflation that some people were worried about because of tax cuts, immigration policy, all that stuff, that hasn't happened. We have some goods inflation, of course, but it's really hard for CPI inflation to break out when you have, just think about it in this light. If energy, remember the whole Trinity thing we talked about? Well, If energy prices are lower and shelter inflation is lower, right? 40% of CPI is shelter inflation. But if you have those two things slowing down and wage growth slowing down, it's really hard for inflation to break out in some Titanic way. I know a lot of crazy people on the internet like to do these dual access charts about the 70s, and right now no, you should literally forget chart crime. You should literally go to jail if people are using the 70s, and we're supposed to be at 8, 9, 10% CPI inflation last year. So with those factors in play, wage growth slowing down, shelter inflation slowing down, and energy prices lower, it's really hard to have breakaway inflation that some people are talking about. So CPI a little bit tame. I know a lot of people are questioning all the data lines lately, but still 10-year yield fell noticeably right off the bat and then perked up a little bit. We've basically been in a range since September. But we're on the upper level of that little channel there. So again, if labor data starts to pick up, right? I think that's the best case for yields to go a little bit higher, but we've got a lot of rate cuts in the system. Mortgage spreads are almost back to normal. The backdrop is much more healthier. And just for some context on inflation data, if you go all the way back to 1910, the year-over-year growth inflation, it's running, the average would be like 3.3% historically. I think we've been below that average for like 18 and 19 months right now. So just a little bit of context on inflation if people were concerned about breakaway inflation. It's World War I, World War II, the 1970s, oil shock, labor force growth, and global pandemic. Those are the only things that really broke inflation out: price control, supply shortages, labor force growth, oil shock. We don't have any of those here. So hopefully that explains why we haven't had inflation breakout like some people. And remember, the Federal Reserve only had a 3% target on inflation. Right. They don't see it really accelerating because tariffs are a one-time price adjustment.
So I think that's my question on this is, looking toward the spring, does this change maybe anything for the Fed as far as like, do they feel like, yeah, now we've got to cut rates a little bit? Does it factor in at all?
Paper, rock, scissors. It's really the labor market forced them to cut one more rate cut more than they want. If it was up to them, they wouldn't really cut anymore. But this is the end of this current Federal Reserve. Wherever I do believe that the White House will just throw away the Department of Justice thing just because it's causing too much confusion right now. But the labor data runs the show. It's really hard for them to justify raising rates or anything like that if the unemployment rate is perking up a little bit. So to me, a lot of people say, well, the Fed has to cut. I know Trump, everybody's saying they have to cut. The markets don't believe anything in terms of rate cuts, maybe just 2 or 3 this year. My thing is that if the economy does accelerate and the jobs data really starts to improve, like we got over 100 to 130,000 jobs created, and the unemployment rate falls down and wage growth starts to accelerate higher, that is the base case for yields to go up. Now, the thing is that whoever is the next Fed chairman is going to ignore that anyway. So it gets a little bit dicey for the rest of the year if that occurs. But that's a variable that we always want to put in everything we need to think about out here. But for right now, the growth rate of inflation is below 3% on a year-over-year basis. Some of the inflation data in this report will really like hit the PCE inflation. That's what the Fed really tracks. But that data line has always been kind of under 3% for some time. So it's just muddling through at this point until we get some clarity on the next Fed chairman. I know we're going to get some announcements at Davos on housing and everything like that. And we just kind of take it one day at a time.
Okay, interesting that you are really just discounting the whole idea of the DOJ investigating the Fed. You're like, that's not going to go anywhere.
The market doesn't care because I think everyone is on the same page here. There's too many Republicans that just won't confirm a new Fed chairman, and that'll drive Trump nuts. And I still don't know why they did this. There's no advantage disadvantage here except you're making like Jerome Powell like a hero to the public to standing up. I mean, whoever thought this wasn't a clever move. Okay, you're kind of toward the end of this whole, and all you're doing is, so that's just tactical art of war kind of thing right now at this stage. We're toward the end of this. Kind of just get it through. Don't make a big spectacle. And I know some other Republicans were saying they better be some damning evidence here if we're so hopefully cooler heads will prevail and we could just push it aside and they could get their new Fed chairman in and move on.
I also think that, you think about the fact that the Supreme Court is weighing that Lisa Cook, the fact that Trump wants to be able to fire her as a Fed governor for cause or not for cause. And like, you got to think the timing on this, like if you left this whole thing alone, you might not spook the Fed. I mean, the Supreme Court, they're people too. They might see this as an overreach and be like, oh, well, we need to make sure he doesn't do that.
Lisa Cook is a dove. Her involvement in the whole equation is not relevant. Beth Hammack would be a target. Now, Beth Hammack is one of our favorite Fed presidents because she's been wrong about the labor market for some time, and she would hike rates, at this point. But I would not be shocked if there was an avenue to go after a Fed governor. Beth Hammack would be the first person that Trump would go after out here if there isn't a plan in the works. And like I always said, if your enemy is already preparing for your demise and you don't see it coming, that's on you. So this is the world we live in, and Lisa Cook is a dove in terms of the voting things. She doesn't really matter much, but a Beth Hammack would be a target because she's very adamant about policy is at neutral. She would like it to be more restrictive. Everything Trump wants, she's pretty much against in terms of it. It's not even Powell or any of them. She would be the number one target for Trump.
Well, and we'll know what the outcome is if he can even do that. Well, we won't know. It goes. The Supreme Court will hear it on January 21st. We don't know when we'll know what they decide. So, but that will be interesting. Okay, we have so many. Oh, sorry. Did you want to?
No, it's Jack Bauer, man. It's just 2026, it's 24. Something.
Listen, I love 24 the show.
We could get off this podcast and something else would pop up. So
I love the TV show. I don't want to live the TV show. No, thank you.
24 was the best. I actually saw Chloe on stage.
Yeah, that's right.
Yeah, and she made a comment about my hair too. But. Apparently, everyone in there had bad hair but me, and I just stuck out. But that's typically the case anyway.
Oh my gosh. Okay, well, we have a number of other reports. What else are you looking at? We've got existing home sales.
Well, new home sales came out today, and of course,
new home sales.
Yeah, I mean, it has been ever. I felt like the lady in Titanic before we got a new home sales and housing starts report. So we got it, and we've always phrased it that the last report before the shutdown was abnormally strong. It should get revised lower because the new home sales is very, very wild. You always kind of want to work off a 3 to 6 month average and take revisions. So we had a 3 negative month revisions, but the trend sales are on the higher end of the last few years. And just remember, new home sales is at 2019 levels. If there was the same thing about the existing home sales market, you're 1 to 1.2 million higher in existing home sales. So they're not working from a very low bar. They're working from a very high baseline. So trending near a 3-year high out there, and it's been really in a range. If you take the COVID-19 burst up and then the 2022 lows, new home sales have been in range since really 2018-19. So not too much going on there. The completed units of sale are still elevated above 120,000. That means they're just going to take everything slow. They need to be able to wind that down a little bit before they get really aggressive. We wrote that in the article so people could visually see the history of how the builders have operated, because they've never been the March of Dimes since the Peloponnesian War, and that's why you need to be the detective and not the troll. But in this case, that was a while ago. That was a few more. Rates are even lower now, and who knows what the announcement. I'm sure there's going to be some something in the works for the builders to get construction going again. But yeah, we're still waiting for a lot more headlines to come on the housing front in a short amount of time.
I know it makes you happy to have your data back.
I know. I was just like, come on, like really, the census, and it's just like, it was so boring. It's just like, you can only look at so many commodity and bond market charts without getting housing data. But, existing home sales, when this comes out, this podcast, we want to frame it this way. When did the housing market shift, Sarah Wheeler?
Yep, mid-June
2025. What happened during that whole frame? Because Redfin told everybody it was the highest seller-buyer gap in history, cancellation rates are all-time highs, delistings and everything. During that whole entire span, the forward-looking data, slope of the curve, we like it, forward-looking data was getting better. The low point in sales in 2025 was 3.9 million. So we always say when mortgage rates get down toward 6%, you could get a couple 100,000 more home sales. Because no matter what the crazy headlines you see out there, forward-looking demand gets better, sales tend to rise with it. Let's just assume that the NAR gets its 4.23 million estimates for that. Well, that means it's a little bit more than 300,000 more home sales from the bottom portion, right? Out there. And so many people ignore this because they saw the cancellations. They saw the greatest seller buyer gap. They thought, home prices were falling and demand was and it didn't work. And now this is three. This is three times since the late 2022. Our forward data gets better, sales get better. We ignore all the noise. We follow numbers because numbers are the closest thing to the handwriting of God. And we have a lot of terrible people on YouTube, Twitter, X, and Instagram, and TikTok. In any case, don't be surprised if that's the case. Whatever it is, the forward-looking data got better. Pricing firmed up a little bit. The growth rate of inventory went from 33% down to 9.99%. We are still in that market because rates are lower. You need duration with a lot of housing data because housing moves very slowly, and we'll see how it is. But it's so far very interesting start to the year. We need about 8 to 10 more weeks. That's why by the time we have our economic summit in February 10th, with all the economists out there, we'll have a good idea of what the spring is kind of looking like, and then where rates are. And this could be the first time in many, many years where we get lower rates for a longer period of time compared to what we saw last year. And a lot of people thought, well, if the Fed cuts rates, mortgage rates are going to shoot back up to 7%, and all. None of that happened. Paper, rock, scissors. Labor over inflation.
Yeah, I love it. That's going to be a great economic conference. Okay, I have some things that are being thrown on the wall. See what sticks, right? Some trial balloons from Trump I want to run by you. So, so I think we've buried the 50-year mortgage, right? Last week, Trump was like, we're pausing on the 50-year mortgage. Okay, so we've killed that. That's done. And then he talked about having using 401ks or 529B funds from those for down payments without any of the penalties that you would normally have. So that's interesting. And then what do you think about that?
I mean, they're going to throw everything they can. It's a midterms, man. You got to throw.
Okay, but do you think that's a good idea?
I don't mind that idea. I don't think that's a very high velocity idea out there. I mean, you I don't remember many people using their 401ks or anything as a down payment. If you can do it without a penalty, I don't see that as a big factor. That's not. I'm a 10-year yield guy, so the 10-year yield to me matters more because the 10-year yield has been the only thing that's really changed the housing demand curve after a qualified mortgage in 2010. So these things are ideas, but you have to test them to see because we don't know how many people have access. We don't know how many people would even want to do this out there. But when any plan is there, you need time to see how it works, right? Because a lot of things sound good. It's like portable mortgages sounded good when they brought it out, but I was like, guys, you can't go back and rewrite those contracts, right? So the portable mortgage is something maybe down the line if you wanted to change the entire U.S. housing mortgage market, but that sounded good, but you couldn't. It would be kind of useless here. And also, more people have 6% mortgages than 3%. By the way, I want to address one question on that. A lot of people, they saw that article we wrote and are trying to dismiss that. Let's just keep the mortgage rate lockdown very simple. From 2010 to 2022, the majority of the profile of homeowners in America had 2.5% to 5% mortgage rates that entire time. When rates moved up, the whole thing was the golden handcuff. Nobody was going to sell their homes. Then it was inventory can never really grow. What occurred every single quarter from 2022 all the way to the third quarter of 2025, every quarter people sold their homes that had low mortgages. Now with housing tenure doubling and tripling, you can see why the turnovers are not so much rate related, but they did. Because if you're a silent generation, if you are a baby boomer, if you are a elder millennial and you bought a house because you had one, you had to give up your low rate. There is no I'm hiding out at a 7% rate. We had 15 years of duration of that rate curve. So if they were any of those people were buyers, Gen X or any of them, they had to give up their low rate unless they were cash to cash. So it happened, right? If we had an authentic mortgage rate lockdown, home sales would be so much lower. I mean, so much lower. New listings data would be so much lower, but we didn't. So 10-year yield goes down, mortgage rates go down, demand picks up over time. We need affordability to get better. That's price growth slowing down, wages, household forms. Housing works itself out. But on some of these ideas, let's wait and see. Whatever gets announced, give it some time first before kind of putting anything in a high velocity, and always go with the 10-year yield and spreads. So that's the thing that's worked in the last few years, even with affordability as bad as it is. That's the thing that's worked in the early 1980s when affordability was worse back then.
Okay, speaking of portable mortgages, so billionaire investor Bill Ackman floating a proposal that suggests mortgage rates could be lowered by limiting borrowers' ability to refinance or prepay mortgages. So he's proposing prepayment penalties, and then he thinks that will also help, like with portable mortgages. What are your first thoughts there?
So portable mortgage is not a thing, nor I don't think it'll be a thing. The prepayment penalties is something I've talked about in the past as well. But let's be realistic here. Mortgage spreads were almost back to normal before any of this, right? So normal in recent history is 160 to 180. We were 2% before. We got near 180%. So the prepaid penalties can mean maybe in the future you get less volatility on the mortgage-backed pricing. But we used to have prepaid penalties for a very long time in the past, and the mortgage spreads were volatile in the 70s, 80s, 90s. We've had periods of times, especially in the late 1990s as well. So I think the velocity of that idea, while it has merit, right? There's a reason why the prepaid penalties were there. It's to affect a better mortgage-backed security market. But the spreads got better on its own. Without any of this, they got from 3.11% all the way down to 2% before even the MBS was announced. That's the main story. So it could give it a little bit of nudge, but I think something like that might have had a little bit more play in 2023, not so much in 2026, because we're almost back to normal. This would have to be a theory that the spreads can get back to maybe 1%, something that in many decades ago, that, we used to have 1 to 1.2% spreads. That's different. But, to me, the story is the bulk of the move of mortgage spread has already been made. Just keep them down here. It goes a little bit lower and just work off the 10-year yield off of that. That's why we do the slowdown, Sarah Wheeler. That's how it works.
Yep. Well, thank you so much. Thanks for going over the data. Also weighing in on some of these trial ideas. Appreciate you as always, Logan Mohtashami.
Pleasure, boss. And I'll let the hair flow out.
Oh my gosh, that hair.